Is my rental property tax deductible? Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's episode, we're talking, is my rental property tax deductible? And we're going to touch on, is the property considered personal use property? Is there material participation? We'll talk passive activity losses and a lot more. So, like I have been doing with a lot of these episodes, there is a flow chart, a Hawaii Retirement Show resource that's posted. It's on the YouTube video and it's up on the website. So you can go to the website, download it, or follow along on YouTube. And it just kind of takes us through all the different avenues to consider when you're looking at whether or not your rental property is tax deductible, right? Are those expenses going to be tax deductible? And if so, how much of them are, right? And that kind of takes us to our first point here, which is you want to first ask yourself, do you rent out your property more than 14 days per year? 14 days per year. And the reason is this determines whether the property is considered rental property or personal use property. If it's rented out for more than 14 days per year, then we're looking at rental property or mixed use property, to be more specific, maybe. That takes us to our next question. So if you rent out your property for less than 14 days, it's just considered personal use property. Maybe you just rented it out for a week randomly throughout the year, 7 days. It's still considered personal use, so you're not going to report it as rental income, and you don't get to take those rental expense deductions, right? You're not taking any deductions and trying to pretend this is a rental property. You rented it out for a few days out of the year, less than 14, so you don't get to take advantage of any of those tax deductions there. Now, if you did rent it out for more than 14 days, the next thing you have to look at is determine, is this going to be considered mixed use property, meaning it's personal and rental property? It's a mix of both, or is it truly considered rental property? And the way you do that is you have to ask yourself, does your personal use in the property, does you using this property exceed 14 days per year or 10% of the days you rent it out at fair market rates? So the greater of the two. So if you use the property for more than 14 days, or if you use the property 10% or more of the days that you rent it out per year, then it's considered mixed use, meaning it's not quite rental property, it's kind of rental property, but it's also personal property, and then it's considered mixed use property. With mixed use property, you're going to report all your rental income. And your rental expenses can be deducted or itemized, right? Your qualified rental expenses, if they do qualify as a rental expense, but it must be allocated proportionally between the rental and personal use. So a simple way to look at this is if I rent the property out, let's say I have a vacation home that I rented out in the summer or 6 months out of the year and I use it the other 6 months. And I have some rental property deductions. Oh, I got to fix the whatever it might be. I got to change the roof, let's say. Well, you can deduct half of that because the property itself is used half for personal use and half for rental property. So you can expense half of that roof replacement, right? Or capitalize it to take depreciation on it. So that's mixed use property. And then the next step that we're going to go down is we need to determine if there's material participation in the property. And the way we do that is you ask yourself, do you spend more than 750 hours per year working in real estate activities? And are those hours greater than 50% of all hours at all jobs you work in the year? Okay, so what does that mean? Material participation, we're really talking about real estate professionals. This is your business. You're like, I'm in the business of, operating rental properties this is what I do. If you're working a full-time job and you have a rental property, most likely you're not going to meet the criteria for material participation. And the reason that's important is if renting out properties and being in the real estate profession is your primary source of business, the tax implications are much different, because this isn't a passive activity for you. This is your primary, source of income. This is what you do, so it's seen more as I guess it's taxed more like as a traditional business as opposed to a passive activity. I don't want to get too much into how real estate professionals are taxed, but it's just good to understand there is a test to determine material participation in, the real estate rental property. 750 hours worked per year, and of those hours, it's got to be, 50% of those hours have to be more than any other jobs that you work in the year. If you don't, right, then it's just considered rental property. It's passive activity for you. I have a job. I work, whatever it is, shipyard, DOE, or city and county, and I also have this rental property that I rent out. That's considered passive activity. And it's important to understand this is passive activity because there's a distinction as far as tax deductibility between passive activity losses and, I would say, ordinary income losses, right? So let's take a little bit deeper look at those tax implications. So going back to mixed use property, some of this property is used for rental, some of this is used for personal use, or I rent it out for 6 months out of the year and I live in it the other 6 months out of the year. The losses for mixed use property, you cannot deduct against your ordinary income because these are considered passive activity losses. So passive activity losses can only be netted against other passive activity gains, right? So if you have passive activity income, you can net it against passive activity losses. But passive activity losses can't be used to reduce your ordinary income, except for one caveat that we'll get to later. Okay, so I hope that makes sense for mixed use property. One thing to say about passive activity losses is it can be carried forward. So if my passive activity income is a certain threshold and I have more passive activity losses, then I bring that passive activity income down to zero because I deducted my losses. And if I have any losses remaining, I can carry those forward in future years to offset, future passive activity income or gains. And the rental income is taxed as ordinary income. If I earn income from this rental property, it's ordinary income tax rates, right? Not capital gains tax rates, just added into your ordinary income for the current year. So the caveat here there's a special allowance of up to $25,000 for passive activity losses that can be used to offset your ordinary income. To qualify for this, there's something called active participation test. So we're not talking material participation for real estate professionals, right? We're talking active participation in your passive rental property. And what that means is you own at least 10% of the property and you make management decisions, which I think most people would. If you're working a job and you have a rental home, you meet the active participation. You're making the management decisions, deciding who's going to be tenants, or you decide who's going to be the property manager, how we're going to fix things, and you own at least 10% of it. I think the only way you really wouldn't fall into this if it was some sort of if you were a limited partner in some sort of real estate type of venture, or maybe, I don't know, REITs or something like that. But most people would meet this active participation, I would think. So if you do meet this active participation, then you have to look at your MAGI, modified adjusted gross income. If it is under $150,000 for the year, then you may be allowed a special allowance of up to $25,000, where if you have excess passive activity losses, they can be used to offset ordinary income. So instead of having to carry it all over, you can use up to $25,000 depending on your modified adjusted gross income, there's a phase out range to offset your ordinary income in that year. If your modified adjusted gross income is higher than that, then you just your passive activity losses are just carried forward. So that's kind of how you want to look at things when you're asking, is my rental property tax deductible? Is first determine, is this really rental property? Did I rent it out for more than 14 days? Am I a real estate professional where I'm talking material participation? Because then it's looked as this is your source of business, so you're going to be taxed differently, and you get I'm sure much more deductions because it is your primary business. And then if it's just a rental property, then you have to understand passive activity losses are used only to offset passive activity income, but they can be carried forward. Your rental income is always taxed as ordinary income. And then there's also that one little caveat, the special allowance. If you meet the active participation test and your modified adjusted gross income, your MAGI is under $150,000, then you may be able to use the special allowance and offset some of your ordinary income with some passive activity losses in that year. Hopefully nobody listening to the show has that issue. Hopefully everybody who has a rental property is exceeding their passive activity losses with a healthy amount of income, and they don't have to worry about that. One last thing I want to touch on, one little tidbit about rental properties that I think some people might not know is, let's say you have a rental property and you're talking rents received, right? You have a tenant that's giving you rents, whether it's via check or via direct deposit or however it might be, even cash. If they give you rent in December, right, for January, let's say they give it to you mid-December, but this is for January's rent, technically, by the letter of the law, the IRS, that is, that you would count that as income in the year of December, right? So if they give you December 2024 for January 25 rent, then you include that in 2024 income taxes because there's a constructive receipt. They gave it to you. You are able to deposit it and access it, right? And therefore it counts as income in that year that you have constructive receipt. You've received it, even though it's earmarked for January rent. Just a little tidbit there. I think it's interesting. Some people might think, well, this is for next year. This is for January, so I'm going to count it as January income. But technically, you receive this income in December, so it's going to be counted for that previous year's tax returns. All right, I think that about wraps us up here for rental property tax deductibility. As always, if there's anything in particular you'd like me to talk about on the show, email it over to aloha@hawaiiretirementshow.com, and I'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.